Good evening, everyone. Sainik sir, good evening.
Good evening, Vipin. Good evening, Vinay. Good evening, Princess. Imja.
Good
And
evening.
Good evening, sir.
तो विनय आप इंट्रोड्यूस भी करिए पूरा टॉपिक और आप पहला बिगनिंग ही आप ही करिए विनय
Ji, sir. Welcome,
जी
everybody. Today's topic is, do you know about the misconceptions of the market? And Sainik sir will be giving some insights about the same topic, as well as Himaji Parekh ji and myself and Vipin ji. And for half an hour to 45 minutes, the speakers will give their insights. And uske baad we'll start taking questions as per the queries and start the discussion. So, Sainik sir, आप सैनिक सर, हिमा जी, आप दोनों में से आप कौन स्टार्ट करेंगे? एनीवन आप में से?
Sainik sir.
Vinay.
सैनिक सर, हिमा जी बोल रहे हैं कि आप स्टार्ट कीजिएगा, तो प्लीज टेक द फ्लोर सर।
पहले आप बोल के गाड़ी छूट जाएगी।
सही बात है सर।
Yeah, it's Himja and not Himaja. Just her name is Himja.
Right. So sorry, I'm so sorry.
Yeah, okay. What's in a name is what Shakespeare said, but we have to, especially, yeah. Okay, first of all, good evening to everyone. Thanks, Vipin Bhai, for sending me as the opening batsman. And the big guns will come later. And I'm like Gavaskar in one way. Many times I'll fail, but sometimes I may succeed. Hoping that Kapil Dev and Kohli and all come in and go for the sixes. So today I'll take about 10 to 15 minutes at request of Vipin. I'll try to be as fast as possible. I will basically touch upon three aspects of the market: investors, the market players, and the corporates. What are the misconceptions these three components have on the minds of an investor? In my experience of 30 plus years, I've met and interacted with at least 30,000 investors across various segments as an investor, trader, teacher, broker, everything. And, I found out the following. Unfortunately, some of these may be a little bit worrisome, but please take it in your stride because this is what I have found out. The first thing about investors, most investors want to make a quick buck. And more than that, they expect the market to give it to them because they decide they want to make a quick buck. I've heard a lot of people who have come to me and said, sir, I want to make at least 3 to 4% per month. Some people think, why can't we make 10% per month? Because many stocks go up 10% in a day. What they don't realize is that if you make, say, even 5% per month, half of what their ambition is, then you make 60% per year. And if you can calculate the CAGR, it will get into huge number by the time you are into the fifth or sixth year. Now, what are the monies they're putting? You want to make 4%, 3%, even 2%, that is 24% per annum, but you're willing to put only 1% of your investable surplus. If you're going to put only 1% of your investable surplus, then how do you expect that anybody will teach you to make those kind of numbers? If I were having a formula to make 24%, then I'll put all my money. You see, it's simple logic. But then people just don't think through that. That is a big misconception they've got, that here is the market, people are making 8% a day, so they will calculate 160% per month and therefore 100 going to 12, whatever the number is. So one has to really look at the expectations. If you look at history or Nifty or Sensex, our Indian market is a bull market, incidentally, and it has given you about 14% CAGR, 14%. A 14% CAGR is nearly 3 times your FD. And that's huge. You see, if you're staying in the market for 10 years, or even, let's say a little longer than 10 years, you get about 14% CAGR, bull, bear cycle, whatever. Say 20 years if you stayed, you will have seen bull and bear cycle. And then if you get 14%, great. And 14% market is given for the patient investor, not for this trader who will do buy today, sell tomorrow, short this one, use some Fibonacci, do all kinds of things, and then you will end up mostly making losses, which we have seen and which has been debate. I mean, has been diarized, and actually one has got research on that. Now, if you look at the biggest investor, Warren Buffett has made 28%. 28% CAGR. So it is not something great is what you will feel, but he's made this 28% CAGR for 70 plus years. He started investing at age 12. Today he is 91. And for these 80 years, his CAGR is 28%. So if you can make 28%, then you will become the first richest investor in the world. So just think in that perspective. Most legends struggle to get 20 to 25% over 2 decades. So the first misconception people have got is, I am God's child. I have to make this kind of return. And you have to show me. Vipin bhai, you have to show me how to make that kind of return. Or Vinay, you have to show me. You have to do more research and show it to me. Why should Vinay, Vipin, or anybody help you out to make that kind of money if you are not willing to put in your hard work? Now, that is the first thing. Then the second thing is, you see, the misconception is market is like a casino. I will go there, I'll buy some chips, and I will begin to trade, and I'll make huge amount of money. Now, who all have treated it as a casino, I will give it in writing. I give it in writing that these guys won't survive 5 years. It is a generally accepted practice that traders don't survive for more than 5 years. Some traders will survive for 10 years. But people who treat it as a casino, almost sure that they will not even survive 5 years. So even if you are very good at whatever technical analysis you have, the market will find to bowl you a googly. So when I say this, I'm saying this out of experience. And if you don't want to believe it, try treating it as a casino for 5 years and come and tell me that you have succeeded, and then then we will talk. I treat the market as a temple. If you treat the market as a temple, then your behavior will be different. That misconception of casino will go away. You will go and beg. You will go and beg to God. Like how you go in a temple, in a casino, you will go and demand the chips. In a temple, you will beg. When you beg to the market gods, if the market gods are happy with you, then you will invariably make money. Believe me, who all have begged in a temple have got their wishes fulfilled more often than not. Hard work always pays. People want tips. And I always tell people tips are for waiters. So I do not want to give any tips. If there is a waiter or if there is somebody who has done service to me, I don't mind giving him a tip. The fourth, these are 3 things which I mentioned. The fourth thing is, most people think for short term. They trade for short term. More than important is they think for short term. How I have understood the markets and what I do nowadays is that I think long term. I think 2024, 2025. And then I trade for the short term. It is not the other way around. When you think for long term, then your trades will be much better aligned with the market's direction. And invariably, you will end up losing less. See, I have been one of the biggest losers in the market. As I keep telling people, over 35 years, I must have done at least 32 years, I might have done at least 30,000 wrong trades. Okay, 30,000 wrong trades easily. So all these experts who tell that they get 90% right and 100% right and always you can make money, they are experts. I am just an experienced guy who has made about 30,000 trades plus wrong. And I'm proud to say I've survived. Why? Because I treat it like a temple. I do hard work. At the end of the day, I find out I don't blame anybody. Okay. Now, this is a main reason for panic when you look at things short term. For instance, yesterday Dow Jones fell 1,000 points. I was doing a clubhouse session. It was down 600 points. The title was 17,500 is safer than 7,500, a question mark. I went on to give statistics as to why it is safer at 17,500 rather than 7,500. So one gentleman asked me, sir, market has fallen down 600 points, Dow Jones. So I said, it may fall 1,000 points. It doesn't matter. Finally, it fell 1,000 points. When you think for very short term, on Monday morning, what I'm going to do, SGX Nifty, what it will do. If you have a misconception that Dow will determine what our markets will do on a long-term basis, then you got it wrong. This is the biggest misconception people have, that whatever Dow does, we have to do. Openings may be right, down. For short term, it may be in correlation. But Vipin Bhai will tell you that, and I'm telling you, there is a decoupling of Indian markets today. It has happened in the past, decoupling, and it is happening today. So I'm not bothered. I don't even have, first of all, I don't have any index positions. So it doesn't matter, but I'm having a portfolio of stocks, about 30 stocks. So all of them could make a downward move on Monday, but it doesn't matter to me. Then, you see, we talk of index all the time. The biggest misconception is that whatever way the index moves, the stock should move. We talk of index, but we buy stocks. There are very few people who actually do trading in index futures. For instance, index futures volumes have actually dramatically come down over the years because many people have moved to options. Options more often than not is lottery because many people want to do hero and zero on Thursdays and invariably end up losing. So when people talk of index, it makes no sense to most people because they're not trading in the index. I look at index through and through all the time because I want to understand if the index is going up. For instance, if index is strong, then stocks are more likely to be strong. It doesn't mean that there is any direct correlation all the time, but if you have the index being strong, that means overall the scenario is good, and therefore the mid caps or small caps or any select stocks can do well. It has happened so many times in the past that index has been good, but stocks have been poor. I always give this example of ITC, which I hold since April 2021. If you take the ITC move between 2013 to 2021, ITC has not moved at all. At 240 to 50 only it was. And Nifty has moved from 5,300 to 18,600. Nifty moved 3.5 times, but ITC, if you have held on in 2013, you have not made any money. Similarly, if ITC, if you have held on from March, when the market was in a bearish trend, ITC has gone up 50%, whereas the market has only gone down for most part of the time. Okay, so it doesn't matter what index does, it doesn't matter what Dow Jones does. What matters is what stock you own. Then I come to the second part, the market players. See, market treats everyone equally. People think that market will treat the big guys differently. The big guys have got bigger risk than the small guys. Biggest misconception is somehow the operators are there. They want to take my stop loss. They'll trigger my stop loss. All these guys are sitting and waiting for me and you, who's having, say, 100 shares in the market. Why will they waste their time to trigger your stop loss with 100 shares? What do they get out of it? So if you really look at it in perspective, the markets treat everyone the same, including the Fed, including the government. If the market has to go up, market will go up. It will not matter whether who is trying to push the market down or up. Okay. Then you have this one about players keep on changing over time, but market remains the same. See, there are operators today, there'll be operators last decade. You have heard of Harshad Mehta, you heard of Ketan Parekh, you heard of Samir Arora, Shankar Sharma, UTI 92 and UTI 98. Big guys have all gone bust. Harshad Mehta went bust, Ketan Parekh went bust, UTI in 92 went into trouble, 98 it went completely bust. Samir Arora had a severe problem here to leave the country and go in 2000. Shankar Sharma had a severe problem in 2001. So you have had major players who ruled the roost at one time and they have gone, into oblivion. Market is always superior. Players keep changing. Market will remain the same. So you as an investor, if you are willing to put in your hard work, put in your efforts, you need not worry about the so-called operators or big guns who can move the market. And the most important thing, the misconception people have in this category of market players is the influencers. Influencers are most dangerous people. They come on mainstream media, social media, and if you are bullish, they'll say market will collapse. If you are bearish, they'll say market will go to some huge numbers. So without thinking, you will go and follow them. Whenever you have any influencer, either a bullish influencer or a bearish influencer, ask the question, what is in it for him to tell me? And why should I listen to him? Is he better than me in any manner? And why can't I do my homework? Does he have the same withholding? Do I have the same withholding capacity as that gentleman? And we don't know what is his background and why is he saying that. So that is the biggest misconception, that somebody is there waiting for you on social media or on in print media or any other media, to the mainstream media, to help you to make money. There is nobody here to help you to make money per se, but directions. See, somebody will give direction, like Vipin will give something, he'll think like that and give. It's not necessary that his will always be right. He himself has said so, I'm saying so on my behalf. But what does it do? He makes you think. He's not telling you, please go and buy tomorrow this particular share. He's saying, okay, this is what I think can happen. So it has to make you think. And that misconception that Vipin, Vijay, Vinay, Himja are here to help you out, I think you should throw it out of the window. Then there is corporates. See, the corporate, there is nothing like a good corporate or a bad corporate. Next 3-4 minutes, I'll finish, Vipin. And then insider trading. Almost everyone is an insider trader. I can tell you that when it doesn't matter what kind of a company it is, whether it is Infosys or Axis Bank Mutual Fund or any company, It is, there are people in the organization who will know the information about the company and then begin to take positions. What we should do as investors or traders is look at the charts, look at volume movement, and then see whether there is something unusual happening. If it's happening unusual, then go in line with that particular price trend. So you need not be an insider. You people think only insiders make money. More often than not, insiders lose money simply because they don't understand the market. They may understand the company very well, but they may not understand the market. As I always say, everybody is an insider in that sense of term. Hamam mein sab nange hain. That's what is the logic I say. And then finally, market almost always reads the corporates wrongly, just as corporates read the market wrongly. I've had people who very high in Wipro who came and sold, wanted to sell their entire holding when Wipro was 3,500, thinking it is extraordinarily expensive during the 2000 boom. I held back and I told the gentleman to wait, and he waited. It went up to 4, 5, 6, 7, 8. And at 7,000, he said, "Boss, I don't want to sell because I think Wipro will go to some huge number." The guy who is an insider thought the market is expensive at 3,500. At around 7,500, he felt, "Boss, market can go up because Wipro is a good company." So this is a misconception even an insider can have. For instance, the markets had a very poor opinion of Dhirubhai Ambani in 1980s. They used to always say that next month it will go bust, following month it will go bust. Think of today we have another A who's also, people are talking of, this guy will go bust next month, next year. He's got political influence. The same story was there with Ambani, because he was going into different areas. But what happened to Dhirubhai Ambani? Dhirubhai Ambani was such a modest person. His corporate office was in Maker Chamber 4, which is, he didn't have Reliance Towers. He didn't have a Reliance Mansion. He stayed in Seawind. For instance, Seawind is a place in Cuff Parade where lots of important people stay there. So he was one of the occupants of Seawind. Okay, so for many years they stayed in a rented place. So he focused on his company, but the market thought he's out to cheat people or who to destroy. There is one person who has actually brought in the investor to the market. It is by far Dhirubhai Ambani. I have great respect for that gentleman. Of course, he's an operator. He might have done things, but at the end of the day, he made the small investor big, and he brought him into equity market. And equity cult, in my opinion, is not from Harshad Mehta, Ketan Parekh, or any other player. It is simply from Dhirubhai Ambani. If you read about him, you will be shocked and surprised that the kind of life he led, and he brought in the small investors. Whereas we have a misconception, thinking that time market had a misconception about that gentleman. Take Narayan Murthy versus Ramaling Raju. In 2000, when Bill Clinton came to India, he went to Ramaling Raju's Satyam Computers corporate office and did not go to Infosys. Why? Because Ramaling Raju was considered a bigger figure than Narayan Murthy. Because Ramaling Raju boasted of different companies. He came from a rich family from Hyderabad. He had many other companies. He always said that he's reading that book, this book on management and all that. And the misconception was that Ramaling Raju Satyam will outbid Infosys, Wipro, and TCS would not become public at that point of time. But the most popular share in the 1999-2000 boom in the tech sector was Satyam Computers and not Infosys. So what happened? Later, what happened? At the end of the day, you know what happened to Ramaling Raju. So you may have a good opinion of somebody, but it may turn out to be bad. So that's a misconception. You need to be very careful. You take Anil Ambani versus Mukesh Ambani. People were so, enamored by Anil Ambani because he had a glamorous wife, he led a glamorous life. So they thought whatever he touches will go gold, get into gold. What happened to Mukesh Ambani? Mukesh Ambani was, like the second guy, he was the elder brother. He was doing everything in, let's say, below the radar. But at the end of the day, it is Mukesh Ambani who actually rules the roost rather than Anil Ambani. But you go back and see 15 years, interviews, you'll have more of Anil Ambani and not of Mukesh Ambani. Same thing with Suzlon. Same thing with many corporates I've seen in Madras Stock Exchange, where they're very, very big and they try to play the market. They thought they can manage the market because they are the persons who issue the shares. And finally, because of their misconceptions and the people, the traders or investors' misconceptions, both of them lost. The corporates went bust, the investors went bust. So I'll stop here. Once again, thanking Vinay and Vipin and Imja Vipin, especially for giving me this opportunity. I'll step back now. Thank you, Vipin.
थैंक यू सैनिक सर. विपिन भाई, बहुत सारे कमेंट्स आ रहे हैं कि आवाज नहीं आ रही है.
बट हम लोग आपस में जो भी सुन रहे हैं हमें वॉइस आ रही है, रिकॉर्डिंग इनेबल है. इवन हमने रिकॉर्डर को भी रिक्वेस्ट डाली थी, शायद वो भी रिकॉर्डिंग कर रहे हो. तो कोई दिक्कत नहीं है. जो भी लोगों को प्रॉब्लम हो रही है दे कैन रिकनेक्ट, मतलब एक बार एग्जिट कर दें फिर से दोबारा रिकनेक्ट कर दें तो शायद प्रॉब्लम सॉल्व हो जाए. कोई फायदा नहीं है दोबारा से बंद करके चालू करने का.
फाइन सर.
तो हाँ,
ठीक है. जो रिक्वेस्ट कर रहे हैं मैं उनको रिक्वेस्ट करूंगा कि थोड़ी देर के बाद भेजिए. अभी स्पीकर्स बात कर रहे हैं. देन आफ्टर दैट विल स्टार्ट टेकिंग द रिक्वेस्ट. मिस रेंजर.
Good evening.
गुड इवनिंग.
I'm sorry, I'm just recovering from a viral, so I may end up coughing in the middle of a conversation. So if I do that, please apologies in advance.
Noted.
So it has been always lovely to listen to Senik sir. I had the privilege of meeting him last week when he was in Bombay, and he always has wonderful stories to share about his decades of being in the market. And I think for everyone for who is young or who is new, is these are lessons that are going to be very valuable. So of course, I think after Sainik sir has said things from a different perspective, I'm only going to talk in a very simple manner. So my take is that it has obviously been a very interesting time in the markets, right? During COVID time, we saw lows of 7,500. Last year in October, we saw 18,600. In January, we saw 18,350, and then we saw a correction till 15,000. And now we almost came close to touching 18,000 again. And of course, again, the entire debate has started: bull market rally, bear market rally, etc., etc. At the same time, we have seen Adani stocks fly like rockets. ITC, yes, ITC has finally picked up for a lot of people that were wondering when is ITC going to start going up again. And then HDFC Bank announced their merger. One of my favorite stocks, Tata Elxsi, touched levels of 10K. Uh, Tata Elxsi was actually also one of the early stocks that I bought, which is why it's special. PSU banks have become very attractive, and basically the party is just getting started. Globally, sentiments are also working in India's favor. A recession in the West is going to be good for us. Smart money will divert its attention towards India, which we are already witnessing. The kind of sellout that we saw by FII has now started reversing. So that feels good. But when this happens, it basically makes everyone feel like I can get rich very quick. Exactly like what Sir said. The stock market is obviously it's a great place to build wealth. But that's the word, wealth. Now, obviously, I don't want to go off on a spiritual tangent, but what we call Lakshmi, whenever we worship Lakshmi, we always say that, I want to worship a Lakshmi that is anapagamini. So, anapagamini basically means wealth, Lakshmi that will stay with you. And in order to do that, you cannot think, okay, that you will get lucky all the time. Yes, you may get lucky once, you may get lucky twice by some tape, by following the herd mentality. But at the end of the day, in order to actually build wealth, you will need a clear strategy, you will need lots of patience, you will need conviction, and most importantly, you will need very good control over one's emotions, because the market can be very cruel if one adopts a gambling approach, which I think we have heard so many times when Vipinji has hosted in his previous spaces, where he has spoken often about people who have lost significant portion of their savings either because they decided to get rich in options, etc.,
विपिन भाई,
etc.
आवाज आ रही है?
आज इस आवाज आ रही है. आप व्हाट्सएप पे पूछ लिया करो, बीच में इंटरप्ट होता है.
सॉरी, मेरे को बिल्कुल आवाज नहीं आ रही है. सॉरी.
इंटरनेट का इश्यू है आपका. Please
Okay, can I?
continue.
Okay. So, I have been investing in the markets for a while. I also come from a family that has always been investing in the markets. My great grandfather had held shares. So, for me, this is something I have grown up with. Personally, I dabble in both equity and debt. And I believe that the market strongly mirrors our life and emotions, and which is why the market deserves, demands, and must be given respect. Tremendous amount of respect. Because the market is forward looking, the market is very wise. It always factors in events that we are aware of and even those we are unaware of. That's why it is always right. Which is why, there is a very popular saying which says bhav bhagwan che, which basically means, the price is god. This is the reason markets also rise during recessions, not because the market does not reflect today's value. It's because the investors always look to the future. Markets are forward looking and they believe in recovery. Hence, when we begin our journey of the market, we are usually bombarded with advice about, technical information, fundamental information, macros, micros, sectoral rotation, SGX Nifty, Dow, Nasdaq, etc., etc., etc. Now, of course, as an investor, these are very, very important. I mean, we need to have knowledge of couple of these pointers that we think are important. Select the sectors that we think we have some understanding of, or people that we know who can help us understand them, and start with a small list and gradually get better. But before we actually do any of that, it is more important to understand ourselves, because when we understand that, that is when we create a strategy that actually works for us, because every individual is different. Just like every trading day in the market is different, every trade is different, every individual is different. One of the biggest misconceptions is that the market is an immediate reflection of the economy. When I'm a student of foreign policy, when I started learning options, I would always wonder that, okay, I see this certain event happening geopolitically, and according to that basis, the index should reflect this in this amount of time. But that was never the case. Sometimes it would happen, sometimes it would not happen. So despite markets being forward looking, stock prices also factoring in the future, the market is not an immediate reflection of the economy. And because stock prices reflect into the future, when one buys into the shares of a company, one is buying into the company's future. Hence, it is important that one must have conviction and stand by it till new facts emerge otherwise. Otherwise, this can be a very, very painful lesson, that we will have to learn the hard way. This method is basically, high conviction investing, which I think, Sainik sir already, he spoke about. Obviously Warren Buffett, Rakesh Junjunwala, most of them, they follow this method, and they always, this reflected in their portfolios, where if they believed in a business, they did not, then they did not sort of look left, look right. They built up strong positions in that business. At times, they even ignored the PE ratios, maybe they were too high. They did not even let technicals come. Conviction really matters. Because at the end of the day, all other factors, all lagging indicators are only reflective of the past. And in a very dynamic world, in a very fast changing world, these are past. And the beauty of data is it can be presented in multiple ways. For every data point, there is a counter data point. Why somebody will say this company is paying out less dividend as negative, somebody will say they are diverting that money into capex, and that is a great positive. So everything can be, presented the way you want. And if lagging indicators really were the holy grail, economists and historians would all be billionaires. But that is not the case. As a child, I remember my grandfather. He would listen to the stock market prices on the radio daily. Back then, there was no internet. He would call his broker daily. He would get the prices of his, 25 stocks that he followed. He could recite them in his sleep. That was his conviction. That was his patience. That was his dedication. And he would rarely get bothered by news and do something impulsive and sell on account of a rumor. Yes, if something very significant came up, if some important information came up, he would then act. Otherwise, no. That is how he built serious wealth. And I'll tell you why I said that becoming impulsive and selling is can be very, very harmful, because today the market is so much bigger. And as India is going to grow, this parallel industry of media, rating agencies, brokers, PMS providers, investment advisory services, etc., etc., etc. There's a huge list of them. They are all, nobody is really independent. I mean, this is not a value judgment, but everybody is here to earn their fees, and that's good. The point is, Lehman Brothers or any other investment bank is going to earn a commission regardless of whether you sell at distress or you sell at profit. Simple. They are concerned that you sell, they are concerned that you buy. What should be of concern to us is, are we selling or buying at the right time? Which is why it is important that one needs to exercise common sense, filter through all this noise before taking any kind of impulsive action with one's investments. Now, there were two incidents in just the last month. A few days ago, a very popular global rating agency downgraded Adani stocks, calling them deeply over leveraged, saying it's entering unrelated businesses. The founder is enjoying a strong relationship with the government. Okay. All Adani stocks dropped. Adani Power, Adani Wilmar are already in the ASM list. Both stocks hit a lower circuit. The same afternoon, a huge buy volume came into Adani Wilmar. Adani Power was put in the ASM. Now, that same rating agency had given the now bankrupt Lehman Brothers a positive rating on the eve of the default. Now, I will go one step further and say that when the said agency said that Adani is entering unrelated businesses, uh, one of the unrelated possible businesses could be exploring a JV with a company that a leading uh, that is very, very known in the petrochemical space, that is in the business of direct carbon air capture, which is obviously next gen. So is it unrelated? In a way, yes, because it is new to it. Any next gen business is going to be unrelated. Does that give you a right to downgrade the stock, or does that give you a right to actually pass such a strong statement? I'm not too sure. Similarly, Tata Elxsi touched 7,700 on the same day JP Morgan gave an underweight rating with a stock price of 3,900. This was 15th of July. It touched 10,700 last week, which was, I think, pretty much its all-time high, if I'm not wrong. And if I'm wrong, please forgive me. After that, this report was circulated in the media houses again, which was an old report. As a result, Tata Elxsi has got a correction of, I think, around 10 to 12 odd percent from its all-time high. The point is that anybody that may have panicked, yes, if you chose to believe that this was enough of a profit for you and you would like to book, that is fine. But if these incidents forced you to do a distress sale or to do a sudden sale because one panicked, maybe it might warrant some thinking to see who has done this, why have they done this, what could they possibly gain out of this. As a student of foreign policy who has co-authored two books, there is a component that we call the economic hitman, which we have covered in our book. And as companies and economies get stronger, the hit jobs increase. It's very simple, and they will also get nastier because more vested interests will join the party to spoil it. So please don't let vested interests spoil your wealth party. I have been fortunate to know some well-placed investors in the market. I often ask them, that how high do you think stock X will go? This is when I would, initially sit with them, and obviously these investors, they have seen the various cycles of the market multiple times. And one of them, would always tell me, he would just smile and say, "Why do you want to predict what the market will do? And who am I to tell you where the market will go? Why don't you simply enjoy the ride?" There is tremendous merit in this statement. Nobody can predict the market with absolute accuracy. It is arrogance to think the market will believe the way we expect it to. There is no such thing such as the markets will peak at this point and then stop, or bottom out at this point and stop. So one can only be humble and adopt a strategy that is per one's comfort. Some may choose to book profits at 20%, some may choose to stay invested at 40, some may say, "I'm going to ride the entire wave, even if it falls, I'll take that chance." It's about what works for an individual. There is no one size fits all. That is why I say it is most important for one to first understand one's own ability to manage risk and emotions. Another big misconception is high risk, high rewards. High risk also means you will go from billionaire to millionaire. Greed is a very powerful emotion. It can be very useful if it's deployed well. What are our main emotions when we invest? Why do we invest? They are mainly fear, hope, and greed. There is hope for a better tomorrow.